Hey everybody, welcome to KF Trades. Don't forget, if you like this channel, hit that subscribe button, hit that thumbs up, hit that bell notification. Make some comments down below, help this channel grow, and hope you guys make some money. Get out there and make some trades. Let's get into this. This video I'm going to show you a trade I made on Google and how the VIX can affect the price on your options a little bit, especially with this higher volatility. So hope you enjoy it. Don't forget, get out there and make some money. Talk a little bit about how the VIX affects your pricing on your options and how it affected a trade I did on Google just the other day. So let's get a little perspective here. The chart we're looking at is a 3-month on Google. So if I have these dotted yellow lines, these are potential resistance points that I have marked. This purple diagonal is just a downward trend line from this low to this previous low, and then it ended up touching it on Thursday, May 12th. Now the funny thing is, this 2193 area, this yellow line, was the low from May 12th, 2021 to the day. And it just happened to be where everything kind of lined up. So when this happened, I picked up an option, 2 options, for expiration of 5/20 on Google at 2400, which was right here, roughly around the 20-day. Because I figured we might get a bounce up that way. There for Google to bounce, and obviously with the stochastic, it's been oversold for quite a while. RSI was low. This is the implied volatility. Runs pretty stable on Google. But the market volatility here on the VIX has been up, as everybody knows. So the VIX, the higher the VIX is, the more expensive your options are. So that's kind of where this comes into play when you're trying to catch a bottom and the VIX is really high, and then you wake up the next day and say, hey, why isn't this up more? Well, this is why, because the volatility starts to move down. So you can see right here on May 12th, it kind of pushed up towards this diagonal trend here and started to pull back. And I think that's where the exhaustion kind of got in here in the market, and everybody started to buy a little bit. So as people start to get back in the market and your stock is going up, you can see the volatility is coming down. And then on Friday, exact same thing, comes down further. So the price of your options is getting less expensive, or if you'd already bought them, you're losing money. So that's the kind of trade-off you're fighting right there. As your stock is going up, you're gaining value in it, but you're fighting the VIX as it's coming down. So there's not as much implied volatility priced into those. And I'll show you here as the example. So here's the 1 day on Google on Friday. So as we had that rise on Thursday that we saw started, and I didn't catch the very bottom, but I got in pretty close. So got a nice rise there. I saw a continuation coming, so I held on overnight. Normally, in this type of market, I probably would not do that. But I took a chance, caught a bid the next day, and it continued up. So on that move, on the daily, on Friday, it moved up to right around here, and I may have gotten out a little bit earlier on this rip right here. Because what happens, I sold right in there, And if we look at the price of the options, that was this move right here. I left a little bit on the table on that next rip, but then you can see as the VIX pulled back on that chart I showed you, the price of those just continued to decline. Even though Google kind of held its price there most of the day, it still continued to drop. So that's why when you're trading options and you get a rip, you have to sell those rips, because you're going to lose, especially on short-term options. You will continue to lose value throughout the day. So if you get rips early, you got to get out of those, take your money and run, consider it a win. To illustrate my point a little further, right around here is where I sold. And this was later in the day as it pulled back, made a bounce relatively close to where I sold, and then pulled back and traded sideways the rest of the day. So on that, let me show you the price of the options. So right in here is where I sold around 11:30, and the price of those options were around, right in here is where I sold actually, 25 to 25.50 is what they were worth. Right over here is that high point, and they're only worth 23. So you sat around all day during this move as it declined, bouncing back up to about the same price, and the options are paying less. So there's why you got to sell these rips early and not sit on them waiting for them to bounce again, unless it's going to bounce and clear and make a new high on that day. But obviously this is not what happened with Google. So that's why you got to take these rips and run. Like I said, consider it a win. Move on to the next trade.